Hi everyone, welcome back. Nice to see you guys. Hope you are sharing this time with me. As usual, I will review what we can expect from the market this week, both fundamental and technical. So let's start by taking a look at the calendar, okay? The macroeconomic calendar. As usual, before starting to see what's up, let's talk about what happened, right? And the fact is that we had a lot of jawboning coming from Fed officers late last week, and despite yes, that has been for the most discouraging. I was saying a lot of them favoring a rate hike and talking about the need of tightening rates and that they are getting ready. A lot of signals that the Fed is getting ready to pull the trigger, which in fact put the greenback on demand back late Friday, right? But I would like to say that the effect was much more stronger in stocks and commodities, right? We have uh, commodities prices falling, stocks plummeting worldwide, risk aversion back on, helped by some news that North Korea, I mean, was performing nuclear tests. And we have the week starting with stocks plummeting, right? And uh, and the greenback modestly higher on hopes the Fed will raise rates. In fact, yesterday we have again a lot of jawboning coming from the Fed, although they're going to begin their silent stage now because we have the meeting in next week, September 21st. So we are going to hear little from them these days until the meeting, of course. But yesterday we have one Fed member, like Lyle Brainard, saying that the bank should not raise rates in advance, right? That the inflation is still low, which is true, and the timing for a rate hike has not yet come. That helps stocks recover some ground and change the sentiment towards the greenback across the board. Although we are not seeing a lot of definitions across the market, right? Uh, we had we have the Bank of England coming on this week, and for most is expected to remain on hold. But I guess the market is waiting again for the Fed next week, which, by the way, will announce its latest economic decision a few hours ahead of the Bank of Japan economic policy decision, which promises to be quite an interesting day next September 21st, 22nd for the dollar Japanese yen. Anyway, so far today we have had some data coming from, I didn't just calendar, some data coming mostly from Germany and the UK. I believe that those are the most relevant figures today. I was paying a lot of attention to the German inflation because, in spite it came flat and it didn't affect much the euro. The fact is that inflation remained quite subdued. Take a look at the harmonized index monthly basis down 0.1%, right? The year on year readings also 0.2, 0.3, 0.4. Really, inflation is still very, very low in the euro area and even lower than what we are having in the States, right? So there are still chances that the ECB will have to do more in the nearest future, right? Uh, while again the Fed is going in the opposite direction, and maybe they won't raise rates this September, but probably will do in December, right? So at the end, that should favor the greenback. Although, well, we are going to discuss the euro in a few, but still trading boringly in a tight range. As for inflation in the UK, right? It came a slightly, let me move, okay, here we are. It came below market expectations and pretty much in line with previous month, although on a monthly basis, it advanced less than expected. Inflation in UK, all right, is expected to continue rising, particularly now that the pound is cheaper and therefore consumption is easier, okay, both for inners and outsiders in the country. So we have expectations that inflation will steadily rise in the UK. Still, I would like to remark that uh, any upcoming Bank of England decision is not based in inflation as it could be in Europe or in the US, right? The Bank of England decided to enlarge its stimulus programs in in August, right? Because of growth, because of economic growth. That's the main concern of the Bank of England, not inflation, right? So don't expect inflation readings in the UK to trigger uh, central bank related decisions rallies. Okay, market is trading growth figures in relation to whatever the bank will decide or may do or may not do in the future, and not inflation, right? I hope I made a point there. I guess I didn't express myself pretty well, but what I tried to say is that the Bank of England is looking for economic growth, take their decisions whether to extend this easing or not in inflation numbers. Inflation will probably keep on rising and probably came out better than this August figures in the nearest future. Anyway, the German sales survey for this September was a bit disappointing since sentiment is shrinking in the euro area. Many blame it on the bank of on the Brexit decision, right? But I do believe that it's the lack of growth that we are seeing in Europe what is hurting investment sentiment in the region, right? Uh, I'm pretty sure that the lack of economic growth we have seen is finally waving uh, on business, and that's not good news. That could put you under strong selling pressure. As usual, when we are talking about fundamental or macroeconomic readings, it's not just one number, one month that can affect the trend of a certain pair, but it's a compilation of a couple of months data, right? And not just one number, but put multiple ones. So beware of that. Don't take my words literally when I'm talking about or something short term to analyze short term when I'm talking about disappointment, such in this particular case. Okay. As for today, the calendar seems pretty empty in the US. I do believe that the only thing that's really relevant will be the AP weekly crude oil stocks by the report because um, it's sort of an anticipation of what the AER report will bring us later on the week. And it could really affect oil prices and therefore put some pressure or favor some rallies in the greenback. Okay, Wednesday, we have plenty of data, minor data coming from Europe. I don't believe it's really relevant, neither Chinese one. I'm convinced that the focus will be in the UK employment figures, right? And let's see what we can get from there. But it's expected modestly better, okay? Although I'm a bit concerned about average earnings being expected below previous readings, right? Um, I really believe that these numbers need to be better than these expectations and better than those previous numbers to actually trigger a pound rally. Okay, industrial production in the euro area is also relevant, but not that much, not enough to wake up the euro. Okay, and as of Thursday, the day starts with employment in Australia. You know, it's quite interesting, at least for those who trade in Asia, because it's usually setting the tone for all of the session. And for mayors during such session, it of course affects mostly the Aussie, but it also affects the New Zealand dollar, and we will probably can see the Canadian dollar replicating the moves of those other two because they are all commodity related currencies. Anyway, retail sales in the UK are at August data. Sorry. Ever since Brexit, we have really tapped in on the small data coming out in July, and a sort of an improvement in August because a cheaper pound has fueled sales, inflation, and so I would expect retail sales for August to beat expectations to be a bit better than what we are seeing in this forecast actually. So hopefully that will also boost the pound. Of course, If the numbers are a miss, that will deny the theory that that August data will result to bidding because of a cheaper pound, and that the economy will grow because of a cheaper pound, and that Bank of England quick decision to act was the reason why the avoided the economic chaos. So that could be really, really negative for the pound, and we may see it heading back towards 130 during the upcoming days, particularly if we have a miss in employment and a miss in retail sales, of course. The Bank of England, it's up next, expected to remain unchanged. So not much of an event this here. The market will be looking for clues on whether currencies uh, uh, wants or to do more in the future or not, and will trade accordingly, right? But honestly, we're expecting them to keep everything unchanged, as you can see in here. In the US, retail sales will be really, really relevant, although we are not expecting much from this. I would recommend you to take a look at the control group, because it's usually moving much more the market than the rest of the figures. Its market is beginning to be more sophisticated when it's trading fundamentals. Somehow it's paying more attention to core data, to the numbers that are um, neat, right? And are telling us the longer term rather than monthly number or than just what's going on right now. It's trading accordingly, much more accordingly to what the future may bring than what actually is happening right now. Producer price indexes is also relevant for me. It will help us to determine whether if inflation in the US continues to be low. A much better than expected number here is needed to boost the greenback. Okay, and for Friday, the main event will be really inflation. I would love to see this core monthly inflation number being well above the 0.2, near 1.0% would be the glory for the greenback. If, of course, the rest of the number go ahead with it. Okay. Uh, and consumer sentiment is also relevant for me to watch on Friday, because it's also going to show us, how the health of the US economy is going on. Anyway, let's go to charts and see what we can expect from there. Give me a second. I will change my screen. Back to charts. Okay, here we are. As I was saying, here is showing little or none life. I have drawn these two trend lines, right? And as you can see, the ascendant one is much more longer than the descendant one, which is at some point favoring the upward continuation in this particular pair. But as we have been talking multiple times ever since, I don't know, last month or so, the pair has been pretty much trapped in range with 800 and 1460 ever since early 2015, right? We have a couple of spikes below, a couple of spikes above, and not much definition. So when we are talking about a bullish extension right now, we are talking about 14, 16, and maybe a couple of spikes. We have this 16, 15, which is this year high, and we have a 17, 17 something, yes, in the middle. But honestly, I'm still not seeing how the euro can go back to 120, okay, because of its own economic situation. There's no economic growth, as we were talking earlier. Inflation is subdued, so what can actually support such rally? I don't know, maybe a collapse in the US economy and the decision of the Fed not only to remain on hold, but to even start considering back facilities, something that seems extremely, extremely unlikely at this point. Anyway, and from the technical point of view, there's clear neutral signs in the daily chart and in the short-term time also. This is the red one is a 20 simple moving average. This is a 200, and the blue is a 101. And if you take a look, they are all together, and directionless and indicators as also directionless around their midlines. meaning there is no clear technical signal in here telling me that the pair will go one way and another. But given that it was rejected from the trend line last Friday, right after surpassing it by a couple of pips, I would say that some follow through above set 113 could help the pair recover ground, in that case 1366 is my first target, right? And above that 14 and 1460 region, which for me is like line in the sun. I don't think that buying the early on this level is a good deal. And on the other hand, we have been holding about 112 for a couple of days already, ever since the past non-manufacturing ESM PMI in the US, which fueled the latest rally, right? So since then, a week already, the pair has been holding about that 112 level. So that should be the level to watch as a break below can take us firstly down to 1160 and then to the lows of seen last week around 1120. Honestly, I'm not seeing much downward potential below that level, but in that case, consider a probable test of the daily ascendant trend line we mentioned before, which for the upcoming days will be in between 1050 and 1060. Okay. Uh, Sorry, I didn't change to smaller time frames. Anyway, back to the daily in the pound. Um, uh, we discussed this 3320 level multiple times over the past sessions. Is the 23.6% retracement of the Brexit slump, right? And as you can see, the pair is still struggling to hold gains above it. Seems the market is not yet daring to push it higher. I don't know, maybe this week with employment retail sales and Bank of England, we can finally determine if the pair will be able to regain that level for good or not. But in the meantime, it's still sort of a selling level rather than a buy. As you can see, spikes beyond it had been unsustainable. So I would say that 135 is the key, right? As only above that level, the pair will actually be longer term bullish. But to the shorter term and in the 4-hour charts, the price is currently retreating towards this week low and the 200 EMA, which for me is a really strong support level, 30 to 30. So this is my immediate support for today. If we break below it, the pair can go short term, of course, down to 3180 region, 3160. Okay, in between 60 and 80, and if we break below 3160, then the risk towards the downside would probably increase, and we can go all the way down to 131. Okay. On the other hand, we have some intraday lows and highs around 32.85. So this is my immediate resistance. If we regain this level, the rally can extend back to 33.20, 33.30. But honestly, unless we have a sharp acceleration, one of those candles, huge candles that show us there's a lot of buying interest in the market, or take a look at this one, telling us there's a lot of selling interest and therefore falling. Uh, anyway, if we don't have one of those candles breaking through this level, that's a little signal that the pair may continue. For technically, of course, I would like to profit there and not go any further higher. Okay. The other one I'm following these days is dollar Japanese yen, because I still believe that the bearish trend remains firm and applied. Take a look at the daily. Every attempt to reach or to break above the 100 simple moving average has resulted in another leg south. What I can see is that we are not reaching fresh lows after testing 100, but anyway, the price has been rejected from that level. A slight improvement in sentiment today across stocks has helped the pair to recover above 102, but I do see that the risk remains towards the downside. There's no clear upward momentum in the intraday charts in here. We have the price too close to its moving average and the two moving average too close to each other to define a trend in a year, right? An intraday trend. But what we can see, if the price manages to extend above 102.50, which is the immediate resistance, we can go up to 103.10. Okay, that's the next bullish target and intraday resistance level. And above this one, up to 103.70.80 seems a probable case or probable target in the case of a continuation. Anyway, back below, sorry, 102, pair can go back to these lows in the 100, 130.40 region. And I could say that below 101, we can go all the way back to 165, which is that major long-term resistance support, right? Is the 50% retracement of the economics rally. Below that level, I don't see the possibility of such movement right now. If something, it will happen next week when we have the Fed and the Bank of Japan both all together, right? And for the Aussie, we had an impressive recovery, a short-lived recovery. And what I'm seeing in here is that the 77 region, right, is now a pretty interesting level to sell. The market is not willing to buy the Aussie as happily as it was a couple of months ago. So I do consider that the risk is now inclined towards downside, although I would like to see a prayer breaking below 74.40 to talk about a steeper decline, right? This is for me a quite strong support level. And if you take a look at the daily or intraday charts, you will see how many times the price held around it ever since setting this year high around 78.30 last April, right? So this is the probable bearish target in the case that the pair continues falling. Technically, the risk is towards downside, although there's no clear directional momentum. Of course, if stocks extend their decline, the risk towards downside will also increase. We will probably reach that 74.40. And the level, the line in the sand towards the upside for me is 76. If we go back above this level, which is another Fibonacci level retracement, then we will probably go back to test 77. However, a couple of weeks ago, I was convinced, so to say, that the pair will be able to retest the year high, and I'm not seeing that so clear these days. It seems that the chances of such rally are limited. Of course, it will depend also on the Fed and employment data in Australia, as we mentioned earlier when we were reviewing the calendar. Will probably had a lot of saying in this also. And about commodities, I'm not really comfortable with what's going on in crude oil prices. I do believe that the market's looking at here for definitions and can't find it. It's trapped between whatever U.S. stockpiles and the supply demand imbalance has to say, and hopes that grow or plummet about whatever the OPEC and the non-OPEC producers will do later this month in their meeting. I honestly don't expect them to reach a deal on output freeze. They have talking about that in April, I do believe it was, yes. And of course, they promised a lot and delivered nothing. They retreat at the last minute. And at this point, they are already retreating earlier. So, despite the talks they are making between Saudi Arabia and Russia, sorry, that they actually want to deal with this market supply issues. The fact is that they are not taking any actual measure to do so. So honestly, I do expect that the meeting will probably be the disappointment, and ahead of that date, I could foresee a sharp decline in oil prices at the moment, at that particular moment. Sorry. Anyway, as for the short term, right? Market attention is still focused in the greenback. The latest move we have seen in oil had been related purely to greenback strength or weakness. So that will probably continue today until the release of the AP report. As I said, is if it does show a large drawdown in stock price, the commodity would probably regain some ground. 47.20 is the probable bullish target, right? And if on the other hand we saw stocks while increasing, I would say the probably price would be again 44.20 and even lower down to this lows around 43.80 or so. Okay, but as we discussed a couple of times already, the commodity is trapped in range 45.52. Sorry, yes, 45.52 is the most likely comfort zone for the upcoming months, and not much outside those levels. And when it comes to gold prices, okay, here we are. The fact is that we continue to be in range and with little definitions. I was a bit surprised that the strong decline in stocks and the fact that Brainard from the Fed down talked the possibility of a rate hike didn't push the commodity sharply higher. Okay, okay, give me a second. Okay, sorry for that. Anyway, as I was saying, I was surprised that the market did not react rushing into gold prices, which for me it's kind of a limitation of the upward potential in the longer term. Still, and for these days, the technical bias in the 4-hour charts favors the downside. With the price below this 33, 35 region, we have plenty of highs, lows, Fibonacci's, and so on. So the risk remains towards downside. Um, and there's scope to test that 1302 low we have seen uh, early September. Okay, and particularly if we see the dollar getting stronger and market sentiment continuing to improve, right? And above that area, we have a couple of resistance 42.50, and this highs around 52, 56, the most I can see it right running. Okay, these days, but the most likely scenario for gold is that it will probably wait for the Fed before settling a clear directional strength. Okay. Anyway, I do believe that's it for today, guys. Thanks for listening. Thanks for sharing your time with me, and see you back on Thursday. I do believe we are going to cover live the Bank of England decision. Okay. Thank you, and see you soon. Bye bye.